Welcome to Chapter 5. Welcome to our introduction to stocks and the stock market. Are you ready? Are you excited? I know I am. Because, folks, for the long term, stocks are where it's at. But, as we're going to see, there's not just one type of stock, folks. There are dozens and dozens of different types and thousands of companies to invest in. And so where do we get started? Right here. On slide number 1, where we quote from a famous humorist of the early 20th century, Will Rogers, who once said, "There are no strangers, just friends I haven't met yet." Yeah, a very warm, engaging fellow. And he said, "Don't gamble. Take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it." Yeah, well, he and his generation and his they were really burned, folks. You think 2008 was terrible, but the Great Depression wiped out people left and right. And so there was a good 25 years, 30 years before people felt comfortable again about investing in the stock market. So he knew from whence he spoke. Slide number 2. What are stocks? And where did the term common stocks come from? You know, we call them stocks, but the legal term is common stocks. And it's an unfortunate term. It came from the 1600s when the investors in these projects, in these capitalist endeavors, were shareholders in common. Every share gave you one vote, and of course you could own as many shares as you were willing to buy. And if you owned 50% plus 1, you basically called the shots. You owned the company. Stocks represent ownership in a corporation, but you already knew that, right? But it bears repeating. You are joining hands with this entity. You are becoming part owner, assuming you hold them for a reasonable amount of time. Whereas people who buy and sell, we don't call them investors. We call them speculators, traders. A better term might be renters, right? They don't really want to own the company. They just want to rent it for a while. And the term for ownership in the financial world is equity. So stocks are equity financing. And you'll hear people say, "Are you in equities now?" And that means are you investing in stocks? They enable investors to participate in the profits and growth generated by the business enterprise. But, unlike a sole proprietorship or a partnership, the stockholders are limited liability owners. They can only lose their investment. And you would learn more about this in detail in our BUS123 class, Introduction to Business. You buy one share for $100 and the company goes bankrupt. That's it, folks. They can't come after you for any other debts that the corporation owns. Now, can you imagine that some people, unscrupulous people, will set up corporations to try to hide assets, and the courts have methods for piercing the corporate veil. But those are shady operators with companies that you've never heard of that aren't real companies. Any company that we talk about in this class, even the ones that are, small, are bona fide individual companies that are trying to make a profit and are trying to compete in the business world. Stockholders receive two wonderful things, folks. They receive dividends and capital gains. Now, both of these are not guaranteed. Dividends are optional payments of earnings. They do not have to pay them, although some companies have been paying dividends for over 100 years. And some companies have never paid any dividends. Also, the capital gains are left to the vagaries of the marketplace, also called capital appreciation, and if we lose money, it's called a capital loss. And If the business grows, if they find new markets, develop new products, innovate, or just darn compete better than the other companies out there, the stock should go up as the business grows, although it's not a one-to-one relationship. Often the stock zooms up in anticipation of something good happening, or crashes when just some little blip occurs. So you have to look at it over the long term. Warren Buffett's teacher, Benjamin Graham, we'll come back to him often. He says, look, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. Yes, and you'll hear people say value will make itself known, right? Value will out. Value will eventually be discovered. Contrary to what many people believe and how many people behave, stocks are not simply millions and millions of worthless pieces of paper that people trade each day for no reason. Well, they're not even pieces of paper now. They're bits in a computer. They represent ownership in real businesses. Businesses that we just take for granted. We see that FedEx truck drive down the street, or we walk into a Macy's or a Costco or a Walmart, or we buy Nike shoes, and these are businesses, folks. And they're trying their best to compete, and some do really well and some don't do so well. And we want to get in on the action. Slide number 3. What's the historical performance? Well, over the long term of modern finance, the return for the stock market as measured by the Standard & Poor's 500, which we've already made mention about, and we'll come back to in our next presentation, has averaged around 10-11% annually for the last 80 years or so, 90 years. And why do we use those 80, 90, 100 years? There's historical reasons for that. We call it modern finance. Around the early part of the 20th century, 1910s, 1920s, and it had to do with the technology of the time coming of age, and the biggest technology being railroads, to the point where massive trade was able to be conducted on a huge scale, never before seen before. And the world, I don't know, a lot of other technologies were coming around too, but that was telecommunications and electronics but automobiles, but that was the biggie, the railroad. And so that's why we use 1910, 1920 or so. In any one year, it is unlikely, though, that the return will be 10, 11%. The return has varied from a high of 53.8% to a low of minus 43.4%. Remember the standard deviation, the variance? And 2008 was negative 38.5, which was one of the worst. In any given year, there's been about a 1 in 3 or 1 in 4 chance of a down market, a negative return. But you don't know what year it's going to be. It's not 1, 2, 3 down, 1, 2, 3 up, down, third 1, 2, 3 up, 1 down. That doesn't work that way. In fact, there was a major exception, and that was 1982 to 2000, where the market there were blips. In fact, the worst day in history was in 1987. But every year, the market just kept grinding higher, even with the downturns. And then we had 3 years in a row where it was down. And of course, we're measuring from January to December, which is just our arbitrary choice of when the year starts or when the year ends. So if we measured it in different years, we might get different results. But still, we have to be prepared that it's not always going to go up. And if you're thinking it is, I've got some bad news for you. But as we're going to see, or as we talked about when we discussed mutual funds, those downturns can work to your advantage, especially if you have a long-term time horizon. And don't panic. Slide number 4. Here's a historical return. Now, we saw this slide back in Chapter 1. And I want you, again, to ignore small company stocks. Yes, they do better over the long term than large company stocks, but just ignore them for now. And notice that, folks, as long as we have a long-term perspective and the world doesn't end, stocks should clobber bonds, which are less volatile, but aren't going to do as well because we're not owning the company. We're just lending our money to an entity. And they should do a whole lot better than short-term guaranteed investments. And, of course, they've clobbered inflation. So where do you want to be for the long term, especially if you're younger? Well, I want to be with stocks, but now I'm older. I'm still with stocks, but now my wife and I are buying more bonds. Not totally. We're going with a balance fund. So there, global. And people, I got this. Just a side note. I'm teaching at Donovan Prison this semester. I'm teaching this class at Donovan Prison. And the inmates are incredibly inquisitive. They've asked me more questions in 3-4 weeks now than any other class I've ever had when I've taught this face to face. And one of the things they keep asking me is, what do you invest in, Mr. Piano? What do you invest in? And I keep saying, no, you don't understand. I'm not here to teach you what I invest in. I'm here to teach you to look at different individual investments and you decide what you feel is a good investment for you. What are good investments for you? But oh no, they didn't take that for an answer. So I showed them what I was investing in and they went, well, that's kind of boring. I said, well, okay. Everybody's a critic. Slide number 5. Here we go, folks. If we take 10-year periods, and this is a really wonderful graph, folks. I think it is. If we go back, starting in the 1920s, and we look at 10-year periods, what we find is a very interesting dynamic. Here we are, starting right before the Great Depression. And here, 10-year periods where the return of this is the Dow, by the way, which is not the S&P 500, but they're often discussed in the same breath, and we'll get into those in more detail later on in our next presentation. We have 10-year periods where the Dow Jones Industrial Average was negative. Well, it was the Great Depression, and volatility was the word of the decade, folks. There were a few years that were absolutely horrible, and then there were some years that were incredible. So you had to hold on for dear life, and if you did, you still wound up losing. But coming out of the Great Depression, coming out of World War II, we see 10-year periods where the market went in two directions, up and way up. The roaring 1950s and 60s, and then finally, 2 generations after the Great Depression, or almost 2 generations after the Great Depression, finally people thought, this is it, stocks are the way to go, and along came the 1970s. And the 1970s were a very difficult very difficult decade for the economy in the United States and the stock market. And why was that? Well, various reasons. The cultural changes that were happening in the 1960s, the civil rights, women's rights, gay rights, the technology explosion that scared the living daylights out of people, sex and drugs and rock and roll. And the one drug that changed the culture more than any other one is legal, and it's only for women. You know what I'm talking about, the pill. Vietnam and Watergate and disco. Ooh, what a terrible time. I lived through that, folks. Disco. It was difficult. But no, what was the main reason? The main reason was the baby boom generation. Coming of age. And all needing refrigerators and washing machines and jobs and cars and housing. It was a very difficult time. But sure enough, we pulled out of it. And you see, we didn't hit negative, but we almost did. We hit just a little over 0% over 10 years. And coming out of it, we see the 1980s and 1990s, where globalization was taking place and technology was exploding. And sure enough, the stock market went in 2 directions, up and way up, until the stocks were overvalued again, as they were in the 1960s, in the 1990s, and blue skies, productivity gains. The internet's going to make everything great. I'll never forget 1998. I was talking to this woman about I had just become a broker, and I was talking to this woman about REITs, real estate investment trusts, which were paying 10, 11, 12% at the time. And she said, this was one of the clients, she said, oh, who would invest in a REIT? In 5 years, no one's going to be going to a grocery store. And I just kept my mouth shut and said, lady, I in myself, I'm thinking, okay, sure. I mean, obviously the internet has changed commerce. There's no doubt about that. But no more grocery stores? Well, there you go, folks. The 2000s come, and sure enough, we get our comeuppance. And we see we have to go back to the Great Depression to see 10-year periods where the stocks were negative. But look at what's happened in the last few years. The market has come back, even though people are still claiming that we're in for gloom and doom, and the Fed has destroyed our economy, and Obama is the Antichrist. And I always have to laugh because Obama's been one of the best presidents for the markets. And it's not because of him, folks. It's because he came in right after 2008, right? Exactly. And so I'm sure that angers a lot of people who hate him. And he is hated. But the president gets all the credit when things go well, and the president gets all the blame when things go badly, but it's not the president's fault, folks. It really isn't. It's our fault. Our economy. We're the ones to blame, but don't use common sense when you talk about politics. It's all about beating up the other person. Are you excited about the future? I am. Now, do we think it's going to do the same thing? I really don't. I don't think we're going to see these kind of returns anytime soon. But that doesn't mean I'm right. It doesn't mean I'm wrong. It just means this is what's happened in the past. But I'm very optimistic, as I've already told you, because of the new generations and the new tools that this generation has lived with. Our generation, we've grown up with it and grown old with it, and we've done our best to adapt. And they are just in it. They never know. They've never known a time when there was a rotary phone, or there was, you just had to send your bill in the mail to the post, through the post office to the telephone company. They've never seen that. And you see children 2 years old banging away on these tablets and cell phones, and you just think, I'm excited. I mean, I'm really excited. But that doesn't mean I'm right, And you never know when called an exogenous event, a tsunami, a meteorite, Ebola, Zika, or some nuclear accident or destruction, intentional. You just don't know. But if we survive, if the world doesn't end, I think the next 20, 30 years are going to be awesome for the stock markets around the world. Oh well, sounds like an advertisement. My apologies. Slide number 6. Traditionally, close to half of the return from stocks was from reinvested dividends. Stockholders used to expect 4, 5, 6% in dividends each year. This was as much or more than bonds returned in interest. Why? Stocks were considered much riskier than bonds. And if we go back to 1936 up to 2008, the S&P 500's dividend average was almost 4%, 3.8. Now remember, a lot of companies don't pay dividends. They're the growing companies. They need the money to reinvest in the company, so they don't pay any dividends. Other companies paid very rich dividends. But in the 1990s, 1980s, 1990s, happened also in the 1960s. Interesting, in the times when the markets were exploding. Dividends fell to less than 2%. It hit 1% in year 2000 at the peak of the internet bubble, March of 2000. Capital gains, growth were what people wanted in the 1990s. Don't pay me dividends. I want you to grow the company. Oh, you're a dividend paying company? I'm not interested in you. And so if we go from 1997 to 2007, the S&P 500 dividend averaged only 1.5%. Half, less than half. Reasons given are varied. Dividends were taxed at a higher rate than capital gains. Well, that's true, but that's not true anymore. That was thanks to Mr. George Bush, the younger. People wanted the business to reinvest the earnings for growth instead of distributing it to the investors. As I said, I want growth. Stay away from those dividend-paying companies. Stocks were no longer considered riskier than bonds. I'll never forget that book, Dow 36,000. It came out in 1999 or so at the height of the market. And this guy was saying, well, stocks are not as risky as bonds. Obviously, look at the long-term average. Without looking at the standard deviation, you see he did not look at the risk involved. He was absolutely wrong. The Dow hit, I forget what it hit, 11,000 or so, and then promptly fell. Savings accounts. Savings accounts are paying less than 2%, so there you go. People lost track of their senses and have bid up the prices. Well, obviously that happened with a lot of stocks in the 1990s. And so we see slide number 7. And we see from 1960 the yield on bonds in interest, which is mandatory. The bond issuers, the corporations, the municipalities, the federal government must pay those interest payments. And the yield on stocks. And we see that in 1960, they were fairly close to one another. And stocks sort of bounced around, fell in the 70s, right before the bear market of 73, 74, when they spiked upward. Why? Because the price of the stocks went down. And then we see the yield of the bonds skyrocketing. Why? Again, 1970s. Everybody's trying to buy cars at the same time. Everybody's trying to buy dishwashers at the same time. And inflation got into the economy. And inflation is the bondholders' nightmare. So bondholders demanded higher and higher interest rates until finally they spiked in 1980, 81 or 2, when the Federal Reserve Bank raised short-term interest rates to break the back of inflation. Also brought us into a very deep recession, 1982, but it worked. And we see interest rates falling for the next 30 some odd years. And we see the yield on stocks falling as people bid up the prices. And there you go. There was the peak. Or not, I shouldn't say the peak, the trough. The trough in dividends and the peak in interest in stock prices in March of 2000, when dividends hit 1% on the Standard & Poor's 500. But since then, they've been rising. And then 2008, they rose sharply. Why? Because the price of stocks went down. And look at the bonds. This is the 10-year Treasury bond, by the way. Every time this has happened, folks, whenever the bond yield goes below the stock yield, it's in the past. It doesn't mean it's a good sign for the future, but it's always been a good time to invest in stocks. Because, exactly, stocks are doing better than bonds in terms of yield. And sure enough, there was a great time to buy stocks, 2010, 11, 12. And then the yield went down because the price went up smartly in 2013. But then so did the yield on, and so they've been bouncing back and forth, right? And bouncing back and forth. And now we're at a situation again where the yield on stocks is higher, not much. And so I'm very optimistic. What I believe is going to happen, doesn't mean it's going to happen, but over the next 5, 10, 15 years, interest rates are going to rise. I don't know if they're going to be slowly rising or quickly rising. In the past, they've risen sharply, quickly, but that doesn't mean they will again. And that's going to coincide with the economy, the global economy getting stronger. I hope. Please. And as that happens, stocks should do very, very well. But it's going to be long term. And come back in 10, 20 years and I might be dead. But maybe not. And we'll see if I was right. I certainly hope so. Slide number 8. The pendulum swings, dear students. The bear markets of 2000 to 2002 and 2008 have changed investors' perceptions about dividends. We now see investors and companies focusing more and more attention on dividends. Many companies that never paid dividends in the past are doing so now. For example, many tech companies, they're no longer growth stocks. They're mature industries. So they've got billions of dollars sitting in cash earning almost nothing. What are they supposed to do with it? Well, in the past, when that happened, a company paid dividends. So it was 2003 when Microsoft, I think it was 2003, when Microsoft finally said, okay, we got $60 billion sitting in the bank. We've written Word and Excel and over and over and over again. We keep getting it worse every time we write it. And Windows keeps getting worse every time we rewrite it. So we don't need to rewrite it. Let's just make it look different. And then take that $60 billion and give it to the dividend holders. Yeah. And the tax law, as I mentioned, has changed so that dividends are taxed roughly the same as capital gains, which is a big boon for the wealthy, as we'll see. So, hey, why not pay dividends? And I love this quote. Now, it's a book, actually, by a woman named Geraldine Weiss, who actually worked in La Jolla. I don't know where she is now. She's probably retired. But she wrote a book. It's not that great a book, but it's a great saying, folks. I love it. I use it often. Dividends don't lie. Dividends do not lie, dear students. How do you know dividends don't lie? Because they write you a check. I don't write a check anymore. It's electronically deposited into your account. But all the other numbers that we're going to see on the cash flow statement, on the statement of cash flows, the income statement, the balance sheet, all those other numbers could be made up, like Enron. But the dividends can't be made up. Why? Because they paid you a check. Because that money came out of your account and came out of their account and went into your account. And this quote is attributed to John D. Rockefeller. Do you know the only thing that gives me pleasure? It's to see my dividends coming in. Now, he probably didn't say it. His neighbor said he said it to him, but we don't know that's true. But still, if you're John D. Rockefeller and you're worth dozens and dozens of millions of dollars in a time when $1 million was a lot of $1 million, yeah, you are you're happy to see your dividend checks coming in. Slide number 9. So let's take a look at the advantages and the disadvantages of stock ownership. Well, they allow the general public to share in the rewards of the business enterprise. Well, great, we get to be part owners of companies that we admire and we think are good investments. They've given us the best investment returns over time, certainly, through dividends and capital gains. They're very liquid, assuming they're bona fide companies. They're companies that are real companies in business. We can easily buy and sell them. We have that limited liability feature that says, you're on the hook for as much as you invested, but no more. And the last one we have on this slide, number 9, shows an interesting aspect that we don't think of because we're in it for ourselves, folks. We're in it for the money. But the capitalist society has shown itself to be the great economic engine that has increased the standard of living for so many people. Now, is it perfect? Hell no. It's got problems like any human system that we've created. It's got serious problems that we have to address. Specifically now we're looking at a tremendous concentration of wealth in a very small number of people, and that cannot continue. It just can't. And call me a communist, I don't care. We have to find some way to get the wealth more in the hands of the common person. And I hope through what I do, by teaching Introduction to Investments, by teaching financial planning and money management, that I'm doing my part to do that, because we cannot have a society where a few people are very, very wealthy and everybody else is just barely hanging on. It won't last. It just won't last. And I think we're going to fix it. I do. I have, again, I've seen people call me Pollyanna, but I really do believe that the politicians will eventually stand up and say, yes, we've got to do something about this, because it's a global problem. But the cool thing is it's happening. It's happening around the world. We see hundreds of millions of people in very abject poverty coming out of that poverty and joining the middle class. So at the same time that the concentration of wealth has, yeah, it's a very strange paradox. So we'll fix it. I believe, I think, I hope. And then, so what's the cons? Well, the biggest con is that stocks are risky, folks, and I think I hope I've shown you how scary they can be, and you probably are experiencing it now, because September is now. I don't care what Mr. Elliott said. September and October are the cruelest months for stock owners, and September is starting off with a bang, or a whimper, I should say, as it often does, where we start losing steam in September, and then October is often the time that people panic, and we'll come back to this later. And then the corporate and financial industry hanky-panky, that's where the money is. Yeah, there's all kinds of shenanigans that go on, but we'll deal with them. We'll look at them. Slide number 10. Remember we talked about volatility. Well, here's 2015, which was a kind of a bizarre year. Started off fairly choppy. So you put in $10,000 and oops. Hope you didn't sell the very first month, because bingo, it jumped. It jumped, not a whole lot, but not bad. And then bang, it's grinding itself up in the summer, and then August comes along. I thought it was supposed to be September. See, the last few years, since around 2010-11, August, I guess people were anticipating September, and August was the time. 2011, it happened in, I don't remember, 2013, then 15. August was the month that people panicked. And what was this panic, 2015? Well, it was the hint of a minuscule rate hike by the Federal Reserve Bank. They finally made good on it in December, but it was just the tiniest little hint that we're going to raise rates a smidgen, a tiny little bit, from 0 to 0.25%, and people freaked out. But as I said before, rising interest rates are usually coincided over the long term. At first people freak out, but they're usually a good sign for the market, because that means the economy's improving. And we came back, believe it or not, in October and November. October is the time when people usually panic. And we ended the year about the same place we started with. So if you held on, you basically didn't lose any money, but you didn't make any money. But of course, if you tried to anticipate, and especially if you sold at the bottom in August when everybody was panicked, and then waited until October to put it back in, you did not do well. So what's the moral of the story? It's not timing, it's time in the market. Yeah, you have to think long term and realize that there are going to be times when the market tank, fall, crash, smash, burn. But those times can be great times to put more money in, as we'll see. So, welcome to our introduction to stocks. Go back over, make sure you know this material, because I'm going to ask you, but more importantly, you're now the expert for your friends and family. And when we come back, we will take a look at the stock markets, where our stocks traded, the exchanges, the over-the-counter market, which is an obsolete term. And we'll also take a look at market indexes. Well, it's about time. We've been talking about the Standard & Poor's 500 and the Dow Jones Industrial Average, and we never really defined what the darn things were. Well, now we are. Now in our next presentation. So, I hope you're excited as I am, folks. And we'll see you in presentation number 2 for Introduction to Stocks.